if Judy Shelton is right. And they do issue gold-backed Treasury. And, she said it would be July 4th, whether or not it is. If they decide to issue gold-backed Treasuries, what you have is a zero coupon bond with no upfront borrowing costs. So you sell a bond to another country or to an investor that is redeemable in gold, zero interest rate, redeemable in gold. And the theory then would be you have zero upfront borrowing costs. You can bring back and build your manufacturing, pay it off in gold. And instead of revaluing it like everyone is talking about, they could market to market, and they should. It's still valued at $42.22 an ounce on the government's books. If you marked it to market, you would give the U.S. Treasury $1 trillion free and clear, just like that. Every $4,000 increase, the U.S. Treasury would get $1 trillion based upon the current accounting gimmicks that revaluing these gold certificates would be. And now Van Eck funds came out recently, Gareth, and said if the dollar lost reserve status, we could see gold going to $139,000 an ounce. That's Van Eck. That ain't me.
Right.
So let's just pretend that is what happened. You sell a $20 million redeemable bond in 20 years. In gold today, it's over 4,000 ounces at $139,000 an ounce. What is it, 150 ounces?
Gold is moving from the background of monetary policy to the center of monetary strategy. The sharp price swings may look chaotic, yet the deeper signal is physical demand, sovereign positioning, and a quiet race to rebuild credibility around hard assets. Gareth Soloway, a respected market technician known for reading short-term price behavior, and Andy Schectman, a leading voice in the precious metals industry, frame recent volatility as part of a larger reset in which gold may matter far beyond investor portfolios. The key prediction is that gold could become tied to sovereign funding and global settlement rather than simply serving as a hedge. Gold-backed treasury structures, zero-coupon bonds redeemable in metal, and a formal revaluation of U.S. gold reserves could give Washington a way to lower borrowing pressure, weaken the dollar, support manufacturing, and manage debt without openly returning to a full gold standard. If reserve confidence breaks, extreme forecasts like Van Eck's $139,000 gold scenario show how dramatic repricing could become. That makes the current market less about one rally and more about whether trust in paper promises is thinning fast worldwide. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Would you think that it would be fair to say that we don't know what the future holds in terms of economic collapse or the monetary fiat collapse, but at some point there will be a reversion back to more of a precious metals backed gold standard type situation?
Yeah, I think that's going to happen in the global south. I don't think we'll see a gold backing of a currency. I think Judy Shelton's idea makes more sense than anything. She's been on my show twice where she speaks of gold-backed treasuries, redeemable with a zero coupon. And when you mesh that in with the Genius Act and look at what Tether's been doing, there's a lot to it that makes me just say, you got Tether, their CEO is Bo Hines of USA Tether, which is the Genius Act compliant side of Tether. Bo Hines was Trump's crypto czar. He's his confidant. And you look at what Tether has done for 3 years in a row. They bought more gold than anyone in the world except the Central Bank of Poland. Over 1,000 metric tons, I believe, each year. They continue to load up on gold with the interest that they are getting from the treasuries that they hold. Now you look at the Genius Act and the Clarity Act talking about not being able to transfer the interest on those stable coins. And anytime money moves after next January, boom, 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 it's backed by short-term treasury. Anytime. That's what is the backing the Genius Act. It's a stablecoin bill. And so that the interest on those treasuries is not transferable. So a company like Tether buys gold. What does that do? Pushes the price of gold much higher. But what does that really do? It devalues the dollar continuously. The only way to devalue the dollar is against gold. It's the only neutral reserve asset by which you can measure anything. Right? It's not another currency. Triffin's dilemma says that other countries sell their currency to buy ours. So it's an invalid measuring. Use it against gold. You devalue the dollar. You push gold higher. This allows you to sell manufacturing to the world. It allows you to also pay down the debt easier. Now, if Judy Shelton is right, and they do issue gold-backed treasury, and, she said it would be July 4th, whether or not it is. If they decide to issue gold-backed treasury, what you have is a zero-coupon bond with no upfront borrowing costs. So you sell a bond to another country or to an investor that is redeemable in gold. Originally, she said 50, and then in her book, she said 5, 10, 20, 30, and 50, starting with the 50 in terms of years. The 50 has a very small coupon. The rest of them, zero interest rate, redeemable in gold. And the theory then would be you have zero upfront borrowing costs. You can bring back and build your manufacturing, pay it off in gold, and instead of revaluing it like everyone is talking about, they could market to market, and they should. still valued at 42.22 an ounce on the government's books. If you marked it to market, you would give the U.S. Treasury $1 trillion free and clear, just like that. Every $4,000 increase, the U.S. Treasury would get $1 trillion based upon the current accounting gimmicks that revaluing these gold certificates would be. But if the Genius Act says anytime money moves, it's going to be backed by treasuries, can't transfer it, and they keep pummeling it into gold. Gold price goes higher. Now, here's the supposition. Here's the conspiracy. Here's the could it be. Bo Hines went in there with Trump and they said, listen, you guys, you were in trouble for a while there, Tether. We're going to let that all slide, right? Here's what's going to happen. You're going to buy lots of, and that gold by proxy for the U.S. government. You're going to sell it to the Treasury down the road, right? We don't want to be in the open market creating all of that supposition. You're going to buy it for us. It's going to end up in the Treasury. It's going to back our bonds that are valued in gold. The price of gold keeps going higher, 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 higher. The dollar goes lower, 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 lower. The Treasury buys it. Now, Van Eck funds came out recently, Gareth, and said if the dollar lost reserve status, we could see gold going to 139,000 an ounce. That's Van Eck. That ain't me.
Right.
So let's just pretend that is what happened. You sell a $20 million redeemable bond in 20 years. In gold today, it's over 4,000 ounce at 139,000 an ounce. What is it, 150 ounce? So you have the ability to pay down the debt much easier, bring back manufacturing and build new updated facilities, sell your product to the world and pay down your debt. And you didn't tie gold to the currency. You still have the monetary latitude to do whatever you want. But the more foolish you are with monetary policy and fiscal irresponsibility, the higher the price of gold is going to go. Well, that is okay if you don't care about a devalued dollar to bring back manufacturing. And the question really to me on a bigger macro thesis, if we don't, what's going to happen to our kids? We're broke. Right. We're insolvent. In essence, we're $200 trillion in debt, right? Medicare, Medicaid, Social Security, government, military pensions on top of $40 trillion. We don't make anything. We hollowed out our manufacturing. That's Triffin's dilemma. And, we're uneducated. 60% of this country has a literacy rate under the 6th grade. Just in time for AI to come and kneecap the jobs. What future do our children have if we don't bring back manufacturing? This country needs it national security. So if the theory was to back the Treasury market with gold, the first thing you'd want to do is see these massive deliveries. Well, haven't we seen that? Yes, you bet your ass we have. The second thing you'd want to do is create a vehicle to push gold up higher and to accumulate it maybe quietly by proxy without alerting the world. Well, you see that too. And then if Judy is right, that's the piece I don't know. We'll find out. If he really does start to back long-dated treasuries, because when you talk about Warsh being a hawk, they're already talking about getting rid of the employment mandate. But what about raising the short-term rates? Well, if money movement is creating synthetic demand for 90-day or less short-term treasuries, you have pinned the front end of the curve to the ground come next January forward. The dual mandate of the Fed is gone. And so when you talk about fine line between conspiracy and reality, I'll just simply say this to you. I don't hope I'm wrong. Not for my business, but as an American, because we're at that point where manufacturing, we cannot be reliant on the rest of the world for everything, from aspirin to aircraft parts and everything in between. We owe it to our kids. We need to bring back manufacturing or we're in a world of hurt. Maybe, just maybe, that's what all this is about.
The stablecoin angle strengthens that case. Under the Genius Act framework, money movement would rely on short-term treasuries with the interest on those reserves remaining with issuers. If major stablecoin firms keep recycling that income into bullion, the effect could be a persistent bid for gold and a gradual devaluation of the dollar against the only neutral reserve asset. This would not be presented as a gold standard, but it could function like a parallel system. Front-end treasury demand stays supported, gold keeps absorbing surplus capital, and a weaker currency makes domestic production more competitive. The strongest takeaway is that the policy goal may not be higher gold for its own sake. It may be a controlled repricing designed to make debt easier to manage and manufacturing easier to revive, as fiscal and political options keep narrowing quickly over time. Now, let's get back to the interview.
I mean, is that stuff really going on? I still remember back in early 2000s where Goldman was kind of pulling some strings in the precious metals to try to keep it down in terms of a price. And so, have you seen that stuff in your career?
Oh, yeah. I mean, JP Morgan paid a $920 million fine to the Justice Department for manipulating the metals market. A lot of people thought they should have got hit with RICO charges. Instead, it was spoofing, and they got slapped on the wrist. The largest fine the Justice Department ever handed out. Michael Nowak, their head trader, is still in prison, I believe. So it's real. You look at the collapse in January in the metals market, the Bank of International Settlements, Gareth, came out and said, no, this was not fundamental, you guys. This was structural, largely blaming the CME group. Well, what do you mean by that? When you realize that the first quarter of the year, the first couple of weeks in January, you have ETF rebalancing. Just like we're ending the second quarter here, you'll have fund rebalancing at the end of the second quarter. But at the end of the year, these funds, these levered ETFs have to rebalance. Now, you look at what silver did and gold did into the end of the year with straight up, way out of whack. They had to rebalance. They knew that this was going to happen. So you had selling to rebalance the ETFs. At the same time, they raised margins by 300%. In the case of silver, it was a roughly, to control a 5,000 ounce contract, whether as a speculator or as someone like me who holds 2 million ounces in an inventory, needs to hedge it, a 5,000 ounce contract required a $15,000 margin account deposit. By January 1st, it was 54,000, 300% increase. And that money, if you don't post it, bang, you're margined out, you're closed out. And so you had selling, which begat selling, which begat selling, which begat selling, and it just watershed down. But as that happens, as it's getting kneecapped, we're seeing the largest gold and silver deliveries in China and the US ever. These people don't look at that as an issue. They don't look at the margin requirements. They're not buying on margin. They don't look at the CPI print. They don't look at anything. They're just looking at this in a non-elastic way and standing for delivery. And if the West is stupid enough to knock the paper price down by using futures contracts that are rehypothecated, levered, and in essence, the tail wagging the dog, they'll stand for delivery. Now, this is how it ends. Jim Sinclair used to always say it. And back then, to your point, it was hard to see it because no one ever stood for delivery, but they are now. And it started with the countries in the global south standing for delivery. No, we want the metal. Thank you so much. And that's where the problems come in. The London Metals, LBMA, London Bullion Metals Association, is a T+1 settlement. The whole first half of last year, they were T+8 weeks because evidently the Bank of England ran short of manpower and trucks to move the bars. So you own a multi-billion-dollar jewelry refining manufacturing company, and you require those contracts that you hold to be delivered promptly. No, Gareth, we're sorry, brother. It's going to be 8 weeks, not the one day that you expect, because we have a shortage of manpower right now to move your bars. So hold tight. In essence, that is what is happening, is that the draining of the exchanges is putting stress. Now, the genius, I believe, of the global south, if you want to call it that, is that they do things in a measured way. It's being cut by a million paper cuts rather than a samurai sword. They know what they're doing, and they're slowly bleeding dry all of the world's exchanges, slowly. Not so fast that they cut off their nose to spite their face, but doing things like that, plus putting a $65, $75, $85 premium on gold to the Western price, and between 10 and 13% premium on silver on the Western price. Please send it to us. We'll pay you that vig. Come on, do it. Yeah. But it's not going away. They're keeping it there to continue through all these channels to slowly bleed dry all of the excess supply that isn't nailed down. And I think you are seeing a rush quietly, what starts out quietly, maybe turns into a stampede later when the public realizes it. But the biggest money in the world is dropping billions every month to stand for delivery across the globe. And that never happened before. To me, there's nothing else that matters. Now, I say that with respect because I understand the power of technical analysis. I do, and I respect you for it, and it's something I wish I understood better in terms of the actual mechanic. But I think this is bigger than that. On at least technical analysis works, but I think where this is going is something bigger. It is a new macro trend where physical demand is outpacing paper promises, and so the market might be changing a bit.
Yeah, and I would happen to agree with you. And I think it's important for everyone to understand technical analysis gives you the short-term price movement, right? So it can tell us when we were extremely overbought earlier this year that we were going to have some sort of correction. But it's the fundamental stuff that you're talking about, which is the bigger macro picture, which will ultimately drive price over the long term. And that's where I am fully. I mean, I'm a huge, I wouldn't call myself a prepper, but I'm to the point where I like to buy insurance, right? And when I buy metals, it's because I'm concerned about when I see the US debt skyrocketing, global debt skyrocketing. There's no care in the world amongst the political elites to control the debt. We see all of these other factors. And then you, like you said, follow the smart money, right? Follow the big money. What are they doing? And it's just, I mean, it's a glaring flashing light, but I think retail oftentimes gets bogged down by, oh, well, I bought it 110. Now it's at 70 or 60 or wherever, this is a horrible trade. But it's you got to look at the big picture if you're in it for the big picture.
100%. There's no question about it. And on top of that, you're seeing all of these new systems being set up all over the place. Dubai to launch the first same-day gold futures contract, and that starts today. They're just launching it today. The Dubai Gold and Commodities Exchange, which syncs up with Singapore, who launched now a deliverable contract in kilo silver bars and kilo gold bars and 1,000 ounce, one contract of 1,000 ounce silver bars instead of 5,000 and 100 in United States on COMEX, 5 1,000 ounce bars and 100 ounce bar, or a 400 ounce gold bar in London. So you're seeing settlement system, same thing is happening in Hong Kong, a new settlement system, vaulting system, Shanghai, Dubai, Hong Kong, all of these, St. Petersburg, they're all setting up and they are all linking together.
The physical market gives the thesis its weight. Paper sell-offs can still occur through futures, ETF rebalancing, margin hikes, and trading pressure. But repeated delivery demand changes alter the meaning of those drops. It points to a world preparing alternatives to U.S. Treasury dominance. Short-term charts may still catch corrections, and retail investors can feel punished when silver or gold falls after a strong run. The larger prediction is that dips may become opportunities for stronger hands to remove metal from the system. Gold is likely to become more important as a settlement asset for trade imbalances, while silver may benefit from the same squeeze in a more volatile way. The conclusion is simple. The market is shifting from promises to possession, and that shift could define the next monetary cycle. That is why the focus should remain on inventories, premiums, and delivery behavior, not just on headlines or weekly candles. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.